listening to the Daily Gold Podcast, covering precious metals, the junior mining sector, and global capital markets for intelligent investors. Now, here is your host, Jordan Roy-Byrne.
Hey, everybody. Welcome back to the Daily Gold Podcast. We had a great interview last week with Vince Lancy, really great response from you guys, and I had to follow that up with another top-notch guest. So with me today, returning guest, Greg Weldon, CEO of Weldon Financial. Gold looks like on the continuous contract, it's peaking above 2,000 today. The stock market's down again. You know, gold's rising while the dollar's rising. I mean, just a perfect time to have Greg on to discuss all things gold and all the macro that comes with it. Greg, first, I mean, there's so many places we can go, but first, why don't we talk about maybe like a two-part question, like just the general macro fundamentals, like what's going on with the economy, and then maybe you could finish that up with how that relates to and maybe what specifically is driving gold right now?
Sure. I think, it's kind of interesting because when you ask about the economy, and we're coming off, a day after we got GDP numbers that gave the appearance, at least, that the economy was robust. I would say GDP is not really the number to gauge the economy on, frankly. When you see that like something like inventory increases is a positive and declining imports is a positive, neither of which are positive economically. So shrug that one off. And the degree to which there seems to be this thought process that we've avoided a recession, that we can have a soft landing, that the Fed's going to be able to declare victory over inflation is extremely short-sighted, Jordan. And here's why. You can say that the economy has held up relatively well because it has. But the reason it has is because the Fed, when you can't start the timeline or the clock running when the Fed first hiked rates, because the Fed was by then so far behind the inflation curve, it's not even funny. They took until like really May, June, even, July, if you will, to catch up and to ultimately get neutral. First of all, it took them a while. I mean, it was May before they were neutral, and then to get restrictive. So they want to get restrictive, and that would be the thing that would start to squelch the strength in the economy. Well, you've really only been restrictive for 5 months. And that's not enough time to have the desired impact that the Fed wants to see on the economy, number one, and on the stock market. I said there's two things that the Fed wants to see, and this is back again when the Fed first kind of got to neutral and then restrictive back in May to June. I said this is great, and then the Fed came out with some really hawkish rhetoric in July, if you remember. And everyone's kind of like, well, we think they're done, but maybe they're not. It's like, well, the Fed may be done, or they may be one or two steps away from being done. But they're not going to let the market know that until two things happen. Number one, you eradicate the easing that was priced into the forward Fed funds strip. The December 2024 Fed funds implied forward rate was below 3% back in the spring. Below 3%. People were looking for 200 basis points of rate cuts, and we're looking for those rate cuts to start this year, if you remember. All right. So number one, they had to eradicate that. There's no way they're going to turn when the market is already pricing in easing from them. No way. They said when it would be restrictive for longer. Well, that just didn't play in with their narrative when you see the Fed funds forwards. That was number one. And number two, you've had disinflation in a lot of things. You've had a crash in the mortgage market. Certainly housing is an issue. I don't know that, I think home prices will soar in the next phase, but still housing has been depressed because no one can afford a house, right? With these rates and with these prices. But in the context of wanting pain in the labor market, yes. Wanting pain in the economy, yes, which we really haven't seen. And wanting pain in the stock market and in commodities markets. And we really haven't seen that. We've seen it in some of the commodities. I mean, it's interesting because somebody asked me about base metals yesterday, in fact. And it's like, well, why haven't, base metals are breaking down now? Why didn't they break down before? If the Fed was raising rates and everything. Same story. Only 5 months of being restrictive, all right? And the degree to which, all these base metals had extremely, if not historically, if not multi-decade lows in warehouse inventories. Now you start to see the economy starts to slow, and what happens? Inventories are rising, and they're rising fast. They're still relatively low, but the degree of increase is pretty shocking, frankly, and that's why the base metals are under pressure. So that's another kind of sign that we're getting some of what the Fed wants to see. But I think that you haven't seen it in the stock market. I think the stock market has, kind of had this last gasp summer rally. I think the consumer is now spent. Savings has been depleted. The wage gains are still negative on a real basis. Your check buys you less by the time you cash it. And I think when you see the wealth effect, come in stocks, that's going to really tip the scales. And when you hear banks start to talk about the higher loan loss reserves against credit card and the higher delinquency rates, that's one of the signs we've been waiting to see, and we're starting to see it.
To follow up on that, Greg, I mean, yes, the short term, the CPI and those statistics have come down. Various people / morons are saying inflation is under control, but you look at long-term inflation expectations. I mean, the break-evens are pushing higher again. You look at the 30-year and the 10-year yields; they're at 5%. I mean, how can they? What are they going to do as the economy slows if these in long-term inflation indicators or indicators of inflation expectations over the next couple of years are still at really high levels? Is there anything they can do at that point?
Well, as a host of a podcaster's interview, you can do a mic drop right now. You just nailed it. I mean, this really is the big question going forward. And I would, add that, frankly, the decline, the disinflation we've seen in CPI and PC was kind of easy to call. It wasn't rocket science. It was pretty mathematically based in the fact that you had a huge decline, you had a huge increase, rather, in energy prices at that, from the spring of last year through to the summer, all right, until the end of the summer. So you're playing off against huge increases a year ago and very high prices. So all of a sudden, energy's down 20 to 30% year over year in several CPI reports. All right. So, and I even said back in June, I think you go to 4%, you might even see a 3 handle temporarily. Well, you got even a little lower than I thought you would. You got to 3 on the CPI, but now the base effect reverses. Really gets interesting in natural gas, by the way, come January, February, especially. But that's a whole nother story down the road. But for the near term, I still think that what's happening in the Middle East is not going to be settled diplomatically. You can't talk about a ceasefire because the thing hasn't even started yet. I mean, come on. You think that Israel is going to stand down now? You don't know Israel, right? And the degree to which, kowtowing to terrorists just doesn't fly. It's shocking to see how weak the U.S. looks. But nonetheless, any increase from here in energy prices goes straight into the CPI pipeline, to the inflation pipeline. So what if 2-3 months from now, and not only that, but a lot of food items too, by the way, have bottomed, have come down big and have bottomed and are already starting higher. Keep an eye on the soybean market. Keep an eye on sugar, cocoa, coffee, cotton. Some of these commodity markets, have been depressed, and some fundamentals are not bad. And there's no margin for error in some of these commodities. So they could go up quickly on any supply side disruption. All right. Within that context, what if inflation, CPI, PCE, whatever, is 5, 5.25, 5.5? Mathematically, that's not out of the question. In fact, it's not even a low probability. There's a decent probability that that's going to happen. All right. And in that context, unless the stock market breaks and energy goes with it, which could happen. All right. Unless that happens, energy is in a position where it's still in short supply on a near-term basis through the end of the fourth quarter. It's still a deficit. All right. So in that combination of things, if CPI, if inflation were to get back to 5.5, what does it do? It totally wipes out the restrictive policy, because with Fed funds at 5.5 and inflation at 5.5, the Fed is stimulative, right? Now, the question becomes, like you just said, do they react to the inflation, especially if you see the economy getting hit, or more importantly, Jordan, if you see the stock market getting hit? All right. And I think they want to disinflate the stock market, but they want to try and do what no one else has dared to do because it's insane, which is to prick the bubble and then somehow, put a piece of tape on it and the air stops coming out. All right. So, watch what you ask for. You just might get it if that's their game plan. But this will be the real interesting conundrum going forward. If inflation rises and the economy and the stock market are rolling over, what's the Fed going to do? And my guess is they're going to acquiesce to higher inflation in some way, shape, or form And that's one of the bullish arguments for gold, even if the economy comes down and the stock market comes down. Gold may avoid the 2008 fate. It might not, but it very well might.
Yeah, it's so fascinating. Yeah, so let's get into gold. It sounds like the situation you're describing. I mean, are we getting to? I don't want to, ask a leading question and just assume all outcomes are bullish for gold, because that's definitely not the case. But it seems
no
like
doubt.
we're getting into that point. You look at the gold chart. I mean, you have this juicy long-term cup and handle. The handle, it's been consolidating for 3 years. It's back at 2,000. Going over 2,000 today. It just seems like the gold market maybe is sniffing out next year. Like, on the one hand, if things really start to fall apart, we have a real bad recession, they're going to have to print lots of money. The fiscal is going to come in again. Or the other scenario where, the economy is just kind of slowly weakening, kind of slowly heading towards recession, but it's not there yet. But at the same time, you kind of have inflation just turning up and starting to push higher, to 4, maybe a little high. It seems like gold, right? Again, I don't want to say every scenario is bullish, but it just seems like if we're logically kind of looking at the scenarios that could come next year, I mean, where's the bearish scenario for gold? I don't quite see it right now.
Yeah, the bearish scenario is kind of just a collapse in all asset prices and people sell everything. And I don't think that that's the way this is going to play out. And I have another thought on that I'll save for a few minutes from now, because one of the things you just said is really kind of interesting in the sense of, let me just think of what it was you just first said, because I'm thinking already 3 steps ahead. So this is what I do.
Well, either both scenarios for gold. I mean,
what you said was scenario. And okay. So when the economy rolls over, what you said here is interesting, because it really does kind of really open a whole nother door of discussion. Because if you say to yourself, okay, the economy starts coming down and maybe the Fed isn't going to be as hawkish as they might have been otherwise with inflation rising, and then you said, and the fiscal side ramps up again. What if the fiscal side can't ramp up again? All right. I mean, does there come a point when they, already you see resistance in Congress, this whole just circus that we've seen recently all around, basically somehow Republicans want to rein in Democrat spending, which is out of control. Albert Einstein said insanity is doing the same thing over and over and expecting a different result. Well, the insanity in Washington is doing the same thing over and over and praying for the same result, that you will continue to float this thing, right? But the budget numbers, which just came out for the end of the fiscal year, end of September, were horrifying, Jordan, horrifying. In terms of public borrowing, in the last 4 months alone, public borrowing is $1.67 trillion. All right. When you talk about the interest, gross interest payments in the last fiscal year, $909 billion. Almost $1 trillion. It's up there with Social Security and Medicare now in terms of spending. All right. When you're not looking even at cutting entitlements, which you have to do. All right. You have to, or the country will be bankrupted by this. There's a fair way to do it. But this means someone's going to pay, and no one wants to pay, and no one wants to talk about that. And any politician, you talk about cutting entitlements in Florida, the politicians on the other side immediately go to the public and say, this guy wants to take away your benefits to the elderly, which is a fraud, because that's not what anyone's saying. You have to have a cutoff date. It's better that the youth of this country care for their own retirement. The government's done a terrible job. Who wants to give the government their money when this is the job they do? They have to borrow $1 billion an hour just to stay open. And that's a mathematical fact. All right. So in that context, what if the fiscal side gets kind of handicapped and you have the inflation side, which at least kind of maybe pauses the Fed? Maybe it's like a stop and go thing, and the defender stops for a second and you get around him. Inflation gets around the Fed. I mean, there's so many ways this could go sideways. And I think what you said on the other side of that too is interesting, because frankly, gold is sideways for the better part of 3 years. It's gone nowhere. Now, I would say that's positive in the context of what the dollar's done. And I would say you have eradicated all the interest in it. I mean, look at the ETFs. Look at the ownership there. It's down. Look at the open interest in gold futures. It's like at multi-year lows or close to it, right? I mean, and this is why it's spiking the way it is. And not only that, but the decline, all right, that you just saw down to 1,800, first of all, held above the first quarter low. All right. It was a perfect 61% retracement of the rally from the 1600 low and the fourth quarter of last year. All right. And it held between the 52-week and 2-year moving averages. It was a perfect ABC, what I call double kill zone correction. Double kill zone being between the two primary long-term moving averages and the two of the three primary Fibonacci ratios, right? Retracement levels. You've done that. And now people aren't owning it. It's spiking. And this is the risk that people miss the move and they're all, climbing over each other to try and buy it, in a scene from Trading Places, which was filmed in the gold pit, by the way. So I think that's kind of interesting the way you put it that way. But yeah, you haven't been able to get above 2000 to 2050 on the front month. You haven't. Somebody is stepping on it every time you get up there. You have weekly and daily tailed downside reversals. You've been up above 2050 in 3 weeks over the last two years, actually over the last 3 years, going back to the second quarter of 2020-21. 3 times on a weekly basis, you've been above 2050. All right. You haven't closed above there any of those times. And you have closed lower on those weeks 2 out of 3 times. So somebody's stepping on it, but they can only hold it down so long. I love to use the analogy. I've probably used it on your program, but it's so applicable here. It's like trying to hold a beach ball underneath the surface in the water in a pool. When you let go, what does it do? Explodes upwards. I think that's the gold market right here.
Yeah, somebody's stepping on it, but I don't know. I get the feeling right now it just seems like that person lost their shoe and they don't have as much power. I mean, what? Well, let me just a technical question for you because I know. I mean, you've been a real trader. I mean, you've been in the pits for decades. Maybe you could because a lot of people are saying there was a triple top, and I mean, obviously, I completely disagree with that, but. What just expand upon that beach ball analogy. Sure. Because how does this work in layman's terms? How you basically you every time you keep coming up to resistance, your gold's been pushed back down, but what allows it to break through? I mean, I don't know, maybe it's a simple stupid question, but add some color on that if you can.
Well, I would add history to it more so than color, and history always brings color with it because I've seen this before, and especially in currencies. When officialdom intervenes, they're successful for a while, but they can't hold the beach ball underwater all day long. They just can't. At some point, their arms are going to get tired, and they're going to let go. And I think you're kind of at that point. And yeah, it is a triple top. I mean, it is. It's absolutely a triple top that you have to break out through. But think about kind of the technical patterns here. 2 points I'll make. I can make various points, but number one is that on a close-only basis, you're very close to the all-time high here. A lot closer than on a straight-up bar chart. All right, number one. Number two would be that you have the moving averages have made consistently higher highs. The 52-week did come down in a period from early 2022 into the later period of 2022, maybe 6 or 7, 8 months. But the 2-year exponential moving average has been pretty much straight up the whole time. All right. So you could say the bull market is been ongoing because the move off the pandemic that you went from 1,200 to 2,000 was very quick. You could look at this entire thing as a giant ABC correction, the C wave being the end of last year's low below 1650. And if that's the case, this thing's about to explode. The second point would be a measured move because you have a sideways pattern here with a very well-defined, channel. All right. Well, really, peaks and valleys, I should say, top and bottom of the range. Very well defined. All right. 1650 up to 2050. Well, normally when you have this kind of move, especially for this long a time period, when you break out, the next immediate move is the same distance as the range had been, which means you're going to 2450 fast when it breaks out. So that's what I would add. And I would add the other thing, we do, I do technical, I do the fundamental, I do the supply demand in all the commodities, all the currencies, all the bond markets, all the stock markets, all the economies. And when we also do quantitative work, I wrote algorithms. I've been a math and science geek my entire life. You wouldn't look at it, think that to know, look at me. But I have these algorithms, and I tell you what, the long term on gold is just kicking in right here, just like the long term on stocks is just kicking in on the short side. These to me are moves that are just starting.
Well, it's music to my ears and the ears of our audience as well. But Greg, two more questions, Greg. I want to get into silver because gold is obviously so close to breaking out, as we've said. But you look at silver, and I'm just pulling up a weekly chart here. I mean, got $26 as resistance. You got resistance at 28, trading at just above 23 right now. I mean, that chart looks kind of sloppy and messy. I mean, at what point? Let's just presume that gold is going to make this break, if not the next week or couple weeks, in the next couple months or 5 months, whatever. I mean, how is that going to drive silver? Give us some color on how silver will act during a breakout move in gold, considering now that it's really kind of sucking wind, although trending higher. I mean, it's just underperforming.
Yeah, I expect it to continue to underperform. I think there will be points where silver will play catch up, and it's going to be fun trying to pick those points of when to shift from gold to silver in the bulk of the exposure in these markets. And there will be time to do that. I will tell you that right now I own both for our managed accounts. We run a CTA here as well. So we own both right now. I mean, I own that. I also own the Bitcoin futures, and we're short the stock indexes and have been long energy until yesterday, but we'll probably be back in by the end of the day, and a variety of food commodities. That's our basic stance right now. I would say that watching the gold silver ratio, it's really almost that simple, and it's breaking out, Jordan. So I think this is a kind of a different dynamic than anything we've seen. If you go back to kind of when you have inflation, you would tend to think that gold would outperform because inflation is also deflationary on the economy, and that's when maybe your silver angle as an industrial metal puts it out of favor relative to gold. That seems to be a little kind of a canned answer, and it is, but that's the reality. And so, I mean, I really am like a hawk, and literally, one of the first things I'm always looking at is the gold silver ratio. And I will tell you this, in the way that gold is breaking out and in the way that stocks are breaking down, the same way that the gold silver ratio is breaking out. So gold is the preferred holding right now, and for the near term and for the foreseeable future until something changes. And I don't know when that changes, we'll adjust our position. But for right now, gold is the key, and gold is the one to own. Although, for me, I like to own both.
Quick follow up for that. Sorry, so many new questions are jumping in my head. Man. But you ever look at the silver against the stock market ratio? I mean, I look at that occasionally, but because you're gold's. I mean, it's outperforming the stock market. It's the gold silver ratio is breaking out, so that makes me think, silver against the stock market. I mean, does that tell you anything? Yeah,
no, it's all the same thing. It really is. Silver, gold, Bitcoin, Ethereum. Even Ethereum is breaking out against the stock market. I mean, Bitcoin's up like 12% relative to stocks over the last 52 weeks. Who would think that right now? Bitcoin's probably going to 48,000. In that case, gold's probably at 2450. The question then becomes, where is silver? So let me just throw the chart up because I really do believe you get above 30, and that's kind of maybe where you get silver involved, where gold is now trading $200 or $300 higher, and silver's lagged, but now it starts to break out through 30, and that makes headlines. All right. And that all of a sudden is like 30. Holy mackerel. That kind of is a level. All right. You weren't able to get through that at all in 2020. You ran into real trouble up there, a lot of selling up there. So that might be the case where all of a sudden you do switch to silver, because that's when silver has its explosive point. When you have cleared all of this overhead resistance, which is much, let's say, nastier, in terms of if it were a minefield, this would be a much worse minefield to have to cross than the overhead resistance in gold, which I think is somewhat fabricated, or at least, artificially placed in there. I don't necessarily see the same thing in silver. Having said that, you also see the dynamic in silver where there seems to be really solid demand almost anywhere below $22. So it's not that I don't like silver. It's just that right now I think I like gold better from a technical perspective, kind of from a psychological perspective. But I like them both. I mean, there's just no getting around that.
Yeah. Okay. One macro question for you, and I'll let you go. Something I've been thinking about, because you go back to the stock market. I mean, 68 to 82 or 69 to 82, that secular bear, whatever it was. I remember hearing Luis Yamada. You probably know the name, famous technician.
Sure. Absolutely.
And she pointed out how it was really the 10-year yield. You had bond yields breaking out that really broke the back of the stock market in the late 60s. And so
Yes.
I'm thinking about that. It's kind of a two-part question. Like, when do these bond yields start breaking this, secular bull that we've had in the stock market? Or, I don't know, maybe it's starting to happen. Maybe we're in the first inning. So that's kind of the first part of the question. The second part is, when is the interest on the debt? I mean, you alluded to this earlier. Like, when is this?
Let's answer the first part first. Let me answer the first part first, because I'll start thinking of something else. You asked me another question here, because that's a good question. The first question is a good question. So say it again. I already forgot.
Okay, well, if you go back to the mid to late 60s,
okay,
we had bond yields creeping up, and then the 10-year went above, I don't know, 5 or 5.5%. That's exactly when you could say the secular bull ended. Right. And so I'm thinking, is that happening now, or how do you see that unfolding?
I believe it is about to happen. Yes, I do. I think I've actually done I've used that time frame, and I've gone back and charted the Dow, because the S&P didn't even exist back then, and looked at some of the dynamics around basically, sideways stock market for 10 years, longer than 10 years. All right. I mean, it went nowhere. It was sideways. All right. It was, and I think you have that, to me, seems almost like there's a lot of probabilities here. There's a lot of different things that could happen. All right. But one of the higher probability scenario in my mind in stocks is they get whacked here. The Fed turns, they try and bail it out. You get your requisite, bailout rally. But, what you see happening right now sets the stage for when that rally comes down the road. Because what we're seeing now is something we haven't seen since 2007 and 2008, Jordan. And that is liquidation of defensive stocks wholesale. All right. You take the XLP, which is the consumer staples, or you take the the XLU, which is the utilities. All right. Consumer staples, utilities, defensive sectors. You would think that when people are getting out of high tech, which has completely led the way, all right, semiconductors not only breaking down on their own, they're breaking down against the S&P, they're breaking down against the XLK infotech sector. So the leader is breaking down against the other leaders, and everything's breaking down against the market. Terrible sign. You would think that some of the rotation would come into staples and defensive stocks like the utilities, of course, which are getting hit by the interest rate dynamic, but hadn't been until just recently. So when you break down the internals of some of the stocks in those sectors, like a Procter & Gamble or a J&J in the staples, all right? I mean, real benchmark behemoth blue chip stocks. You're seeing huge volume and declining on balance volume and breakdowns through technical levels we haven't been below in literally 13 years, all right? When you take something like the 52-week moving average and the 2-year moving average, in both the XLP, consumer staples, and the XLU, utilities, that is turning bearish for the first time since 2010. It's been bullish for 12 years, and it's reversing. And the trend lines are being taken out. And the liquidation is huge. So back to the scenario where you get this decline, you get the Fed rides the white horse to the rescue, all right? But they're not as effective as they've been in the past. The fiscal side is kind of hampered because you just can't keep printing money the way they print the money. And even just in the last 4 months, public borrowing is $1.67 trillion just in the last 4 months. And all of a sudden, the stock market comes down. It's kind of a slow bleed, and you go sideways for maybe 2-3 years. I mean, holy mackerel. Think of the economy then when you don't have the wealth effect from stocks. Credit is crimped because, you need growth to just support the amount of debt that's been created by consumers, businesses, and the government over just the last 3 or 4 years. Without a high rate of real growth, you're ultimately going to choke on all this debt. And that's where maybe you come into a global lost economic decade. Now, that's a gloom and doom scenario, but it's also not a 0% probability scenario either, especially if a war pops off and the U.S. actually gets baited here by Iran, which looks increasingly likely to happen, let alone, Jordan, we've talked off the air some about the science and the physics on this planet and some of the things that are actually happening that, human beings want to control climate control. They can't control it. This is so much bigger than human beings. You're talking about tens of thousands of years of cycles that are all combining in a once in 25,800 year point in time where polarization is the key, and higher vibrations, higher resonance on the planet are key. All right. What this does is upsets, everything. The weather. Look at politics, how polarized it is. Look at the weather, how crazy it is on every side. It's record drought and record floods. It's record everything, right? This is only going to continue for literally, I don't even want to go there. It's almost depressing. But what's happening here now plays into all of this. And when you consider China pulling the puppet strings here of Iran and of Russia, the new axis of power on that side of the world with a manifest destiny dynamic, we're already in a resource and asset war. And they are winning. They have the more powerful weapons. We are asleep at the switch, worried about, who is the latest pop star that has 2 million followers on YouTube that, basically generates nothing in the bigger picture. All right. So, and I'm certainly not one that's ever going to say China's the better system. It's not. Of course, democracy in the United States model is the best thing in the world. But at the same time, it's being corroded. It's corroding. And, we look weak, man, on the global stage. I mean, Biden in Israel was hard to watch. And no wonder our enemies are gathering on the horizon together, ready to take us on like they've never been ready to take us on before. You hope to think that Iran's just using rhetoric to terrorize people, but I don't know about that. But when they captured or killed some of the terrorists that invaded Israel, they found, documents and plans and all kinds of instructions and where to find stuff that they wanted to do and all this stuff that dated back over a year. So consider when Iran says the U.S. will suffer, in the U.S. if something pops off here, you could kind of say they have a year to have placed all kinds of cells in this country where if a war breaks out, they actually bring it to us here. Think about that. So, never has there been a time in my mind where the risks are higher. And that's the best argument of all for gold. It really is. So I guess I could leave you with that, a dour note. I'm a very positive person, when it comes to life and just, things in general. But when it comes to the economy and markets and what's happening geopolitically, I don't see much to be positive about, frankly.
No, I understand. I wish we could end on that note, but I do want to get in the second part of the original question about, maybe this would have been a better question to ask like 3 or 4 months ago. But I'm wondering, when will the interest on the debt, like when will that actually start to matter for the economy? When will that force us to have to do yield curve control or something like that?
Well, now, starting now already. So this is another thing. Well, that's why I kind of reacted the way I did when you said, down the road, the economy starts to weaken, they'll break out the fiscal punch bowl again. It's like, yeah, well, that punch bowl is not going to be as full as it's been in the past. So you better line up because it'll be empty before a lot of people get a cup in their hand. Right. So I think that is a major factor. These numbers are parabolically high. You can't support this, man. Something's got to give. And yeah, it will affect the economy because the government just can't. Government transfers are still almost $4 trillion on an annualized basis every month. They're still handing out money like crazy, man. And then it's like, okay, well, Israel's got a problem and Ukraine has a problem. And guess what? I get it. I empathize absolutely 100%. Especially when it comes to Israel, right? But at the same time, it's like, we're broke. This country's broke. And it's like, okay, well, we'll help you out. We're going to go borrow another $100 billion from the public and we'll send over some weapons. It's like, do we not understand the insanity of this? That the government's insolvent and they just keep borrowing money. And it's, you could make a case that it's kind of a Ponzi scheme. All right. Because what they're doing is they're taking people that are paying into Social Security and retirement and all this kind of stuff now to pay the benefits for the people that have already retired. It's like a reverse Ponzi scheme because the people that are paying in now, that are in their 20s, Social Security will be dead and gone by the time that they retire. There won't be any money. So what are you going to do about it? No one wants to fix it. It's a political freaking, pipe bomb. No one wants to touch it, but someone's got to. And this is where it really is really bad when you see the two-party system used to be our strength. It is now our downfall. Because this country is so divided, it's difficult to see how you get unity. What's the candidate out there who's going to bring unity? Certainly not Donald Trump. Can't be Biden again. I mean, it's hard to find somebody, man. I mean, it's sad to say this is the best we got. But to answer your question, starting now, and that's a whole nother drag on the economy that has unintended consequences that are a drag on the economy.
On that note, Greg, so great to have you on. Thanks so much for giving so much of your time to us and our audience. Before I let you go, please tell our listeners how they can follow your work and the services that you offer that they can learn more about. Sure.
I mean, we do research and we manage money. So the CTA, we're Series 3 registered for accredited investors only. You can email sales at Weldon Online and that. We are accepting new money right now. We don't always because I think the ground is fertile for major moves and big returns, doing a lot of things. And I think for people, that are, stock market people and buy and hold people or passive investors, that is not the wave of the future. It's going to become increasingly difficult to keep pace with the debasement of paper money. Like Jordan said, they will print again. It's the only way out. We chose this path in 1990, the last time we could have whittled down debt and actually got organic growth. No, we didn't do it. And now this is the only way out. And when they're staring into the abyss of a debt deflation, they'll choose to reflate every single time. I wrote that in my book in 2006, and it's never been more true than it is today, years later. In that case, the money management side could appeal to people. And the futures market is a tool that if you know the math and you understand the risk like I do, having done this for 40 years, it's one of the greatest things in the world to really take advantage of what's coming next. The second part of that's the research service. We do the New Age Investing Portfolio Playbook, which is to help stock guide people with different portfolios that we offer. Again, focusing on the top sectors and the top stocks in the top sectors. If you want to be long stocks, then you really have to be selective here. All right. And the recent lack of breadth in the rally is testament to that. So that's the portfolio playbook. And then we do, of course, the Weldon Live, which is our benchmark product. It's been around for over 25 years, covers the globe, specific recommendations in stock indexes around the world, bonds around the world, all the currencies, all the commodities, energy, metals, industrial metals, food commodities, agriculturals, everything. We offer, I just did a big report on the budget, by the way, 43 pages. If you want a free copy of that, and you want to maybe get some information on our service, and I'll send you a free copy of the portfolio playbook that we just did and give you all the portfolios in there that my clients pay for. Just because I've known you for a long time, Jordan. You were like a kid when we started talking, man. So you've come a long way, baby. I'll give you a lot of credit for that. You've done a great job, which is why I'm always happy to contribute. But you can always find me by emailing sales@weldononline.com or me directly, Greg Weldon, Weldon, @weldononline.com. And we're doing the podcast too, by the way, now too. Check out our podcast and check me out on Twitter @Weldon Live or @money_podcast. And check out our podcast. It's really growing.
Awesome, Greg. Yeah, thanks so much for coming on. Just fantastic insights from a real master. Really appreciate it. And hopefully we could do this again in the coming months. I'm looking forward to doing some interviews when gold's in breakout mode and trading above 2,100.
Yeah, I think the next 3 to 6 months are going to be highly profitable for people who do what we do. Yeah.
Thank you for tuning into the Daily Gold Podcast. For more interviews, editorials, and analysis, log on to TheDailyGold.com. And for premium coverage of precious metals and the best junior mining companies, visit TheDailyGold.com/premium.